Welcome to video number 2. In video number 2, we're primarily going to be focusing on permanent life insurance. Now, there are a few different forms of permanent life insurance. We are going to focus on whole life insurance. The other two forms of permanent life insurance are universal life and variable life. We will not be going into any information on those types. In this video series, however, I will be doing videos on those at a later time. So let's keep this simple, right? Term insurance expires after the term is up. Permanent insurance does not expire until the individual passes away or lives to the age of 121. If an individual lives that long, which can happen, right, the insurance company will pay out the death benefit at age 121. So the biggest difference is you will have lifetime death benefit coverage. That's one of the biggest pulls to permanent life insurance versus term. Okay. Now, as we talked about in the previous video, the longer that the term is in force for, the more expensive that the premium will be. So with that in mind, when you have a permanent life insurance policy, that's going to be much more expensive to have in force because the insurance company knows at some point in time in the future, they will have to pay out a death benefit. So that's why the cost is significantly more. However, there are ways to tweak the numbers and design of the policy so that we can bring that premium down as low as possible. We will be diving into that in some of the videos coming up. That's where it will get very interesting and intriguing. That's what most people do. That's what I personally do. We won't dive into the details of that right now. This is just going to be a basic overview, touching on some points of permanent life insurance. So as you can see, I have underlined up here that you will have lifetime guaranteed coverage. Okay, as long as you're paying your premiums, and you will have a minimum required premium that has to be paid, you will have coverage until you pass away. That's the big benefit. Another very big draw to whole life insurance is a large portion of your premiums that you are paying into the policy are going towards your cash value. So your cash value, 30,000 foot level, right, is an alternative savings account. That's one way of looking at it. So you're building up and accumulating cash inside of your policy. That cash value does earn guaranteed interest. And on top of that guaranteed interest, it will also earn dividends. So we use mutual life insurance companies, and that essentially means that we participate in the profitability of the insurance company. So at the end of the year, the insurance company will share some of those profits with us, and that is in the form of a dividend. Okay. Let's touch on these 4 points that you see here. Okay. And I will say this, I've outlined this top section that you can see here, because this is what most people will use as far as a whole life policy design. There are other forms, like I mentioned, where the death benefit is the main priority. However, myself, most of my clients, they really want to have that cash value accumulation occurring in their policy. So we're just going to focus on this. So with this first point, you can see that you will have protection guaranteed to age 121. And as an example, like I mentioned, if you do live to age 121, the insurance company will pay out the death benefit to you. Okay, so people are living longer now than they previously have. The insurance companies have adjusted for that. This number actually used to be 100. So just recently in the past, I think it was 5 years, they've changed that to 121. That is because people are living longer, which is a good thing. So this second bullet point is touching on the strong long-term cash value accumulation and internal rate of return. So again, most people are heavily focused on this. They want to see that their cash value is getting a return, right? So we will go deeper into this from a numbers point in some of the later videos, which will be very, very interesting and intriguing. You'll definitely want to stick around for those. Okay. This third bullet point is something that we're also going to dive into very deeply. You have a lot of flexibility in regard to the amount of premium that you can put into the policy and that you're required to put into the policy. We're not going to dive too deep into that right now, but you do have the ability to max fund your policy, which basically means you can put in more than what you're required to. And also there are some short pay designs. So one common misconception with whole life insurance is that you have to pay into it for your whole life. That is not true. So we will dive deep into the short pay designs, which is also a very, very popular design that people will use. So we will dive into that. And then this last bullet point just kind of touches on the amount of riders that you can have attached to your policy. We won't dive into this right now, but you can have multiple different riders attached to your policy, which can also contribute to the growth of your policy, the flexibility of the premium that you're putting in, the death benefit growth. You can also have your death benefit increase every single year, which we'll touch on that too. So this first slide, that's all we're going to cover. In slide 2, we're going to look at that same male, age 45, using a preferred rating, and we're going to look at premium amounts using a permanent life insurance policy versus what we looked at with a term life insurance policy. In slide 2, we're going to focus on a permanent life insurance policy on a male age 45 using a preferred rating. And what you're going to notice right off the bat is that his initial premium, and this is, again, this is an annualized number, is $18,400. You'll also notice, right, I've highlighted it in red, that that's very, very high. If you recall, when we went through the term policy on this 45-year-old male, the term policy premium per year was $1,200. Now that's a significant difference going from that $1,200 per year up to the $18,400 per year. We've discussed why that is and how that is calculated. So the understanding is the term insurance is very cheap based off of the term only being in force for a time frame versus the permanent policy premium being much higher. And that is due to the fact that the death benefit is in force for his entire life. Now, what if there was a way that we could reduce this premium significantly and still have a death benefit remain in force for his entire life? That's what we're going to really dive deep into in the next 2 videos. However, to wrap up video number 2, we're going to come down here, and what I have outlined is 5-year increments and how that looks as far as a cash value accumulation perspective. So if you look at year 5, this client has put in a total of $92,000. His cash value after year 5 is going to be right around, say, $52,000. That is very, very low, very slow start. You can see in red again, low cash value. The death benefit has slightly increased from that initial 1 million. And every single year after year 5, the values do get more appealing with this traditional whole life design. However, years 1 through 5 is what really turns people off to this asset. So in the next video, we're going to look at years 1 through 5 using a traditional design, which is what you're seeing here. And we're going to compare that to what is called a high cash value design. And again, that is where we're able to significantly bring down this annual premium that is required. And it's also really going to increase the value of the cash value in the early years. So as an example, after year 5, we may see a break-even point, essentially, where he's put in 92 and he has 92. Slightly less or slightly more. We will look into that. So that is your general overview of a traditional whole life insurance policy design with a male age 45 using the preferred rating. In the next section, we will begin Life Insurance 201, where we will dive into how we design the policy for high cash value. We will look at short pay options, long-term pay options, and really focus on the power and flexibility that you have with the policy. And then once we conclude video 5, we will then jump into Life Insurance 301 for videos 6 through 10, where we will really get into how you can use the policy, the tax benefits of the policy, how it's a private asset, et cetera, et cetera. So thank you for staying through the first 2 videos. Videos 3, 4, and 5, we will pick up some steam a little bit and things will get a little bit more exciting. So thank you so much.